Now, our top story today, though, is the jobs numbers. Yes, today's numbers painting a mixed picture. Employers adding about 103,000 people in the payrolls for December. Now, the unemployment rate did fall to 9.4%. On the other hand, more than 3 million Americans say simply stopped looking for work. They dropped out of the workforce. Well, how should we interpret the numbers? Let's ask a Bloomberg best economist. We have David Semmens of Standard Chartered Bank. David, good to have you with us on Bloomberg, as always. All right, so what do we make of this report? People dropping out of the workforce so they don't get counted, and also people who are just losing their unemployment insurance benefits, they also don't get counted. So what do we take away from this?
Well, I mean, the main problem here was that the big decline you saw in unemployment, there was a partial improvement within the household survey. You did see hiring pick up there, and that was responsible for about 0.2 of the decline, but then the additional 0.2 of the decline, which took it down to 9.4, was really from people leaving the labour force because they're just discouraged, because you're now having around 44% of people who have been out of work, or who are 44% of the unemployed have been unemployed for more than 27 weeks. And people just lose heart and leave the labour force. And that's really the key problem, is people are just leaving now. So this is really what is holding unemployment down. If unemployment was at the same if people were participating in the labour market at the same rate as they were at the beginning of 2008, we would be back up towards the 12% mark. So this has really held unemployment down. Now, the problem is when you go into a recovery, this holds unemployment up and stops it because once people get encouraged, they come back into the labour force. But unfortunately, people are still discouraged, so it's just a really bad sign.
All right, so when we listened to President Obama speak about the jobs report, he was looking at very positive indications, the unemployment rate going to 9.4%. Is it likely that we're going to have another news conference in future months where he talks about the unemployment rate going up?
Right, exactly. I mean, once people start feeling more encouraged, they're going to re-enter the labour force, and this will drive unemployment back up. And unfortunately, that's something that you would like to see, because you want people to come back into the labour force because they are encouraged and they are seeing hiring out there.
What about the revisions that came out today? They actually painted a more positive picture.
Right. I mean, the fact that we've been seeing upward revisions for the last few months now is encouraging, but unfortunately it's really not enough to be driving down the unemployment rate, and it's really not enough to change the overall picture.
Now, where did we see some of the hiring? We looked at healthcare, for example. There were some manufacturing jobs, I believe about 10,000 there, restaurant jobs, maybe 47,000. Is there any indication that the uneducated workforce is reaping any benefits in the job market?
Well, the thing is, you're actually seeing a bigger pickup in the jobs that are typically lower paid than the higher paid jobs. But the sector that really has caught everyone's eye is the fact that when you look at education and medical care, that sector has risen 9.4% since the beginning of 2008. Now, when you contrast that with something like the construction sector, which has seen 27% of their workers lost, it's really a massive dichotomy within the economy. You're really seeing some sectors benefiting simply because you can't do without education, and if you're sick, you have to get treated. Whereas the construction sector is far more cyclical. So that's the real difference you've seen there. And the reason you're seeing much weaker wage growth is you are seeing jobs on the lower end of the pay scale being added rather than the higher end jobs.
All right, David, so we take a look at the jobs report, we peel it back a little bit. It's not so great, even with the revisions that we received today, even though the unemployment rate went down to 9.4%. Can you break it down a little bit further in terms of education? I know you've been doing a little bit of prep there. Yep. So what is it? If you have a college degree, you're more likely to have a job.
If you have a college degree, you're sitting at about 4.8 at the moment, whereas
4.8% unemployment with a college degree.
Which is historically, it's very high. It's normally around 2.6 historically. So obviously, we're seeing almost twice what we would normally be at. But when you haven't finished high school, you're sitting at about 15.3 at the moment, and that's averaged around 9%. So you are seeing a bigger increase because there's a high number of people who are less educated. But everyone is suffering on this. It's not just a universal increase on the lower end or the higher end. Everyone is seeing an increase in unemployment rate.
All right, is this a big deal for investors? Because it seems as though the stock market kind of shrugs off the news. It doesn't look at the unemployment rate necessarily as a leading indicator. And we know that the stock market is a discounting mechanism. It looks into the future. People kind of expecting this. Bernanke coming out today and saying it could be years before we get a, quote, normal job market again.
Right, exactly. I think the thing is people are looking at the income. And when you look at the total income earned, we're actually back towards the previous peak. I think we're just around the previous peak that we had back in 2007. And it depends on how you look at the number. However, those people who have jobs are seeing an increase in their spending, and it is encouraging. You are seeing the US consumer spending more than they had been. They have been showing a better appetite for spending, and they've been showing a better sentiment. So that is really the encouragement that the market
Well, you're
is
going to see it
taking.
also on the FICA line of your pay stub in January,
Right,
beginning in
exactly,
January,
yes.
because that FICA tax is going to go down, so you'll have less taken out of your paycheck.
Right, exactly. So you've got the 2% tax deduction from your Social Security, and also you've seen the extension of unemployment benefits. So the deal that we saw in the middle of December was pretty much everything that could be done, unless you lower tax rates even more or raise unemployment. That was a very positive deal for the US consumer. And the other thing is, when you have interest rates that are going to be on hold for a long period of time.
Well, I was going to ask you, does today's report support the idea that we continue with $600 billion worth of purchases by the Federal Reserve?
We would see the risk being more, not less, simply because the economy is having so much support at the present, and you want to see the momentum gathering. You don't have any inflationary pressure. If they were having strong growth at present, they would be saying, this is wonderful. Quantitative easing is working, but look at inflation. Inflation is still very low.
Core inflation.
But then headline inflation is still very low, and it's very limited with regards to commodity price inflation. And it is core inflation that you should focus on, because the commodity price inflation will drop out the following year, assuming commodity prices don't carry on rising rampantly. But really, from our perspective, we don't expect the first Fed hike to come until the first quarter of 2013.
2013, after the election?
After the election, simply because we feel
everybody wants to keep their job.
Well, it's more that the Fed wants to make sure its job is done. They don't want to be accused of hiking rates too soon. They would rather deal with inflation as a problem than have to go back to the drawing board and focus on growth again.
Does that make sense? Do we have any historical precedent for that being the correct action?
Yeah, exactly. Well, when you look at the Great Depression, they raised rates too soon. And when you look at the early 80s, there was a monetary contraction.
Monetary contraction.
And unfortunately, those contractions were very deep. And we don't want to have those situations again. The Fed's done a good job, in my opinion, so far, and I think they will wait until inflation starts to creep up.
We did get some manufacturing information in the last 2 weeks. Are you seeing any changes in manufacturing productivity or manufacturing increases? Because that's also got to be linked to the kinds of jobs and to the productivity issues. If companies are facing that the demand can't be met with the workers that they have, the next step is maybe temp workers.
Right. I mean, when you look at the ISMs, both the manufacturing and the services were very encouraging this week. And when you look at temporary workers, you are still seeing strong additions. Now, that could be taken as a good leading indicator because people are adding to the workforce, and then they're going to turn these temporary workers into permanent workers. Now, the problem is when these people don't become permanent workers and you're just seeing continual additional temporary hires, and you're seeing people being hired without the benefits that they need. And so this is a problem. And also they can be laid off very quickly, so that's a far more volatile way of hiring people. But it does suit companies far more to do that. But when the economy turns around and you do see strong hiring, they're going to want to lock people in to be permanent workers rather than have workers who can move around all the time.
What about next week? What do we look forward to, and what are some of the big economic reports that you think are on traders' and investors' minds?
Well, for me, on Tuesday, you've got the NFIB, which is the small business survey. Now, you've seen small businesses really lag the improvement you saw in the ISMs, and that's actually been edging up the last couple of months. Now, it would be interesting to see if this can move up for a third month. We're hoping that it will, and we're looking for that simply because you've been seeing a relaxing in the strictness of credit standards. So,
well, I got to admit, every time we talk about small business, I'm always swamped by emails from small business people that say, no, the asset-backed lending, that's gone away. It's being replaced by revolving credits, by credit cards, and that's not really helping their business because it's very difficult to actually afford that kind of credit. What are you seeing? Anything?
Well, you have seen in the last Fed survey that you were seeing better lending. But the problem is they're not really relaxing their standards aggressively. They are just relaxing them very slowly. It's a very cautious approach. But the thing is, you are going to have businesses now that are far better equipped to deal with it, because if you've lasted this long, then you're used to this environment. If you're starting now, you're starting when the economy is obviously very weak. So it's not like you're running downhill, you're running uphill, and you know you're running uphill. So as a business, you know what you're facing. And so it's perhaps better to train running into the wind, and then when you are running away from the wind, you'll be able to run stronger when the economy is better.
All right, so we got small business on Tuesday. Anything else we need to pay attention to next week?
Well, there's CPI, which obviously is going to be key for the Fed, but we're not looking for anything too exciting from that. You're not really seeing any inflationary pressures. And then when you look at PPI, there is slightly more pressures there on the producers.
All right, we're going to have to leave it there, I'm afraid. Thank you very much, David Semmens, joining us from Standard Chartered Bank. Always a pleasure, always great insights.